Indian commercial real estate has witnessed a strong recovery over the last 4 years. Vacancy levels have fallen and rental rates have gone up. And the consolidation following the funding crisis has left fewer players with potential to rake in the benefits. These are some of the factors that have turned the ICICI Securities bullish on the sector. To get a deeper understanding of the factors here, we're in conversation with the author of the report, Adhidev Chattopadhyay. Adhidev, good afternoon and thanks for taking the time out. Let's begin by talking about the falling vacancy levels as well as a rise in rental rates for especially commercial real estate. What are your key findings here, and who are the key who possibly could benefit from this trend now?
Yeah, good afternoon. Yeah, see broadly, if you see in terms of a vacancy, the pan-India vacancy for Grade A office space was above 20%. This is around 5 years back. This has fallen to around 15% now. And even among them, the larger markets, right, of Bangalore, Hyderabad and some areas of Gurgaon now have vacancy levels of well below 7 to 8%. So clearly there is a supply shortage in the market and the supply is concentrated in a few hands. At the same time, you have seen that even the rentals, right, have gone up at least 50 to 60% in certain micro markets over the same time, 4 to 5 years. Some of that has been obviously due to the currency impact, and of course the remainder can be attributed to the improving demand supply dynamics of those individual micro markets in those cities. So already I've seen quite amount of decent recovery, and as we had mentioned earlier, there's a lot of consolidation already happened in the space. There are just now 8 or 10 large pan-India developers of office space who have access to institutional funding. So with this funding now, they are embarked on a fresh capex program to add more assets in their kitty. And with a favorable economics of building new assets, they will be further adding to the rental income over the next 3 to 4 years, and over a longer period it becomes a recurring income stream. Also now with the emergence of REITs as a potential monetization tool for all these companies, I think more funding will be forthcoming to the sector going ahead, and that is why we are bullish on all the office asset developers in India.
Hi Adhidev, good afternoon. Well, definitely we've seen a lot of institutional foreign money coming into this space, and what a contrast when you compare this to the residential market where there is a lot of unsold inventory. In fact, the recent report indicated there are some 12.7 lakh unsold inventory among the top 30 cities in India. But tell us, you've mentioned a couple of reasons. There's money coming in, foreign money, you expect the rentals to go higher, but what sort of growth are you expecting at least in the next 2 to 3 years in terms of rentals?
Okay, so there are two parts to this. Obviously, one is the older properties, right, the existing properties which are at the older rentals. Now they would be around 20 to 30% below the rentals which the new completed properties are getting. So obviously when these come up for renegotiation, they would again get marked up to the current market rate. And of course, other than that, you have the new assets which are going to become operational over the next 2 to 3 years. So the combined impact of the two, so expecting all of the developers to at least register a double-digit rental growth. This is just talking about the rental rate which they will be getting, which will be a mix of these two factors going ahead. Because as you know, most of the existing projects have a contractual escalation of around 15% every 36 months. But as you see more relocation, consolidation, and people shifting to better offices, the larger players with the better spaces and campuses are getting a higher appreciation in their rentals.
Okay, so Aditya, if you could talk to us about companies that you feel which are better placed to take advantage of this. I reckon DLF will be one. Which are the other companies that could be also in this list?
Yeah, so among the listed players, obviously DLF stands out in the NCR market. That is the single largest player over there by a long way now, with most of the other players having trouble on their balance sheet or having sold off their assets. DLF clearly is in pole position in the Gurugram market. Among other listed players, Oberoi Realty now has in its whatever its upcoming projects for the next 4 to 5 years, around half of its portfolio is concentrated in rental assets across offices and malls. And you have the incumbent players in Bangalore like a Prestige Estates, Brigade Enterprises, which already have a lot of operational assets, plus a lot more assets will be coming on stream over next 2 to 3 years. So obviously these are the key beneficiaries of the uptake, just not just in rentals, also in the demand for the office space.
Adidev, you have a sell rating or a reduced rating on something like Godrej Properties. Why is that so?
Yeah, so Godrej Properties, see, we are very structurally positive on the company. That is, it is the key beneficiary of consolidation. So however, it is still early days on quantifying the sort of market share gains and how this would translate into profits. So we are still awaiting clarity on, as the company scales up further, how the profitability and all these things pan out. So per se, we are structurally positive on the sector consolidation story, the larger organized players gaining market share, and Godrej Properties, with a strong brand, has achieved very good sales growth last year, and we expect this trajectory to continue. It is just that again, in the sector, being a player with very good corporate governance and a good set of disclosures, the investor confidence is higher, which is also reflected in the stock price. So there may be one or two aberrations in the price itself, but structurally the story remains intact for the company.
Okay, Adidev, we spoke about the commercial realty space. How are you viewing residential property in general at this point? Because from our understanding, we still have a very sluggish movement in terms of sales as well as rentals. Have things changed substantially over the last 1 or 2 quarters?
Yeah, so if you look at most of the listed players, right, the 8 or 10 guys among who have the better balance sheets in the listed space, all of them have had a very good year in FY19. The sales are up at least at least in double digits. In case of some companies, in the case of some companies, the sales have almost doubled in this current year. And these players have a very aggressive guidance for FY20, where they are targeting again at least a double-digit growth. At the same time, you see the sales have been flat, or have been like maybe in a 0 to 5% range across cities in terms of the sales volumes. So clearly the larger organized players, whatever new launches they are doing and even the ready projects they have, they are continuing to see takers. So that is the segment of the market which continues to do well. However, the problem remains with legacy or stuck projects. So there are around 600 million square feet of projects across the country which are stuck. Now in value share, the MMR and NCR have 70% of the share in that. The problem with a lot of these projects is that they are just stuck midway. Either the developer has run out of funds, even the financing options have already been exhausted, and with no customer confidence in the project to generate fresh sales, these projects are basically stuck. What you hear in the news, especially about large projects in the NCR market. So what is happening now for customers, although there is a huge amount of unsold inventory as it is on our headline number, but more than 50% of that is not actually sellable inventory, or not an inventory where a customer would actually go and buy. So a customer who actually generally wants to buy a flat is gravitating to the larger organized players where they have some certainty of the approvals and the execution. So I would, although again the inventory levels would continue to look high, but if you just segregate that into the actual completed inventory which is there on the table for buyers, it is not that much. And most of these, lot of the larger players, none of these players would have any stuck projects in the pipeline. So overall, for select number of people, the outlook remains good. However, as you rightly pointed out, for majority of other smaller and unlisted developers, the situation continues to be pretty gloomy.
Adidev, just last question. What's the downside risk to your hypothesis that the commercial real estate space will outperform going ahead?
Yeah, so obviously the biggest risk to anything obviously is the demand outlook. So as we have already pointed out in supply side, right, as it is a capital intensive business, right, it requires a lot of funding. You need to spend 3 to 4 years to build these assets. You need to have strong leasing teams who are able to source the deals and get your occupancies done. So now this time the supply, I would say, is controlled in that sense. So I do not see much of an issue on the supply side. More the issue is on the demand side. Suddenly, like there is a drop down in the what you say, the ITS sector. And this we are talking about the global ITS sector. If you see in office demand in India, 2/3 of the demand is driven by MNCs, which are companies which are headquartered outside the country. So if there is any slowdown in their expansion plans, that could hurt the demand. So that is the only risk that we see for the office market, because otherwise I think a lot of the larger players have already learned from the previous cycles. They are more disciplined in terms of the supply they bring into the market, what sort of rentals also they want to charge from occupiers. India still remains one of the most affordable markets in globally, with just average rentals hovering just around $1 a square foot a month in most of the peripheral and suburban micro markets across the top 7 cities in India.
Okay, all right, Adidev, we leave it at that. Thanks so much for taking the time out and speak to us here on Bloomberg Quint.